Ladies and gentlemen, welcome to day 5 of the Future of Money Online Summit. My name is Ryan Andrew Peterson with Conscious Marketer. We're one of the producers for this event, and I just want to welcome you to the call. In a minute, we're going to be joined by John Tarr and Fred Thiel. And I just want to get you excited for the lineup of speakers we have coming up tonight and tomorrow. Tonight, we're going to have Nick Halick at 7 p.m. Pacific time. Nick is the author of The 5-Day Weekend, and he's self-proclaimed the Thrillionaire Entrepreneur Alchemist. So you won't want to miss that one. It's going to be an incredible call. And then we have a full lineup tomorrow. We're going to start at 7 a.m. Pacific time with Kay Zhu from China. She's going to talk about her decentralized social network called Ono. Following that at 9 a.m., we have Evan Karen talking about how we use blockchain to reward and incentivize pro-social behavior. And then at 12 p.m. Pacific time, we have Warren Kritko, who is the founder of Crypto University. At 4 p.m. Pacific, Andrew Hewitt, who is the founder of GameChangers.io. And then at 7 p.m. Pacific time to end the day tomorrow, we have kind of a panel with TJ Matai and Chris Dow. And they're like crypto influencers and highly influential in the space, so you won't want to miss it. And then lastly, if you notice below the video, there are some social icons and buttons for Facebook, Twitter, and Google. If you click those, you'll be able to share this information with your friends and family. That would be awesome if you could do that. Social media is making it pretty difficult to get this important information out there. So if you could help us with that, it would just be great. But without further ado, John Tarr, take us away.
All right. Thanks. Hey, everybody. It's John Tarr, and welcome back to the Future of Money, which is the world's largest live online cryptocurrency summit. I'm John Tarr, entrepreneur, investor, and founder of Totally Crypto, and I'm super excited to have Fred Thiel on with me, and I'm going to introduce Fred in a second. I'm going to share our get out of jail disclaimer real quick. The content of this summit is provided for informational purposes only and is not intended to provide any specific tax, accounting, legal, or other investment advice or provide the basis for any financial or investment decision. You should always consult with a licensed professional to seek advice specific to your own situation. Quick reminder, too, that our special offer during the summit to get you over 40 hours of talks, 25 plus speaker bonuses, and a program called the Cryptocurrency Master Program is available right now. Regular price on that after the summit is $497, but you can have it for $297 and get all the great talks, including the one I'm about to do with Fred. Let me introduce Fred. This is quite the bio, and I am excited to have him. I've been thinking about our talk all day today, and I hope I'm doing justice. So Fred is a senior advisor to management teams, board of directors, private equity, and venture capital firms. He sits on private and public company boards. He's a respected expert and frequent speaker on the Internet of Things and the digital transformation of companies and industries, providing deep technology, industry expertise, and strategic advice on transformational value creation, the process of generating growth and shareholder value. Fred has over 25 years operating experience lending companies in all these spaces. Check this out: technology, data communications, internet, automation, big data, digital media, and software industries. He's repeatedly driven rapid growth and generated hundreds of millions of dollars in shareholder value. As a CEO, Fred has led companies through rapid growth IPOs, repositioned companies for high-value exits, led M&A and roll-up strategies, as well as successfully executed corporate turnarounds and wind-downs. Fred's deep industry experience spans all kinds of places. And so what he's going to talk about today, let me just say this real quick. Fred, you speak 5 languages on top of all this. You attended classes at Stockholm School of Economics and executive classes at Harvard Business School. You're a current member of WPO and a former chapter chairman of the YPO, California Coast chapter. Man, you've got a lot of experience, Fred. Welcome.
Thank you. Happy to be here.
Yeah, I'm excited to talk to Fred. Fred, I want to open this up. Now, we have all kinds of people converging, and you've been in the technology space for a long time. We're going to talk about that. Technology is sort of a magnet for young people. Young people get in this space, and you're a very experienced person in this space. And I want to get your take on basically the one question I've been asking people is, how do you think that this cryptocurrency thing is impacting the global future of money, basically? What's your perspective on all this?
So it's a great question, very complicated question that most people think cryptocurrencies and blockchain are solely focused on money. And you got to kind of bifurcate the two, because blockchain is a technology and distributed ledger is a concept that applies to lots of things that have nothing to do with money. It's simply a way to track data and transactions, and Bitcoins, if you would, are simply data. And the blockchain is the technology that allows you to track that. Digital currencies like Bitcoin and arguably Ethereum and others are really a store of value. And unlike any other types of currencies, there's nothing really backing Bitcoin other than limited supply and high demand. So it's a commodity, really, which is the way a lot of the regulators view it. As we look to the future, is there going to be a U.S. digital dollar, if you would? Well, there already is a U.S. digital dollar, and most governments already have more of their GDP transacted digitally in their fiat currency than they do in cash. As a matter of fact, Sweden, where I come from originally, 96% of all transactions are done digitally. So there's no real need to exchange those currencies for digital currencies because they already exist. Everything you pay with a credit card, everything you pay on your phone is technically a digital currency. Most people don't understand that. So if we think about what is Bitcoin and what are Ethereum and these digital currencies going to do to the world economies, I'm a bit of a naysayer, I guess. I don't think they're going to really affect economies a whole lot, because what is going to happen in the broader space is these digital assets are going to eventually be absorbed into traditional regulated models. What is a traditional regulated model? A bank, for example. Banks today are not allowed by regulation and national rules to hold and trade digital assets. The minute banks are allowed to hold and trade digital assets, then it's a whole different marketplace we're talking about. And you have to really start looking at the fact that most tokens are really securities, and there's some form of securitized asset. And whether you believe in that or not, or whether you're a faithful believer in the fact that your token is a utility token, in reality, most of them are just forms of store of value, and they're going to be characterized by regulators, who are the important people in this equation, as securities, and so they're just a form of security. So I think we're not going to see a lot of disruption from digital currencies. What we are going to see is a lot of new businesses enabled because of them, and where you really see an opportunity for digital currencies to play a big role is in international trade. So it's not going to be about how you pay for your airline tickets or how you go to the movies or whether you're going to go to Costco and pay in Bitcoin or not. It's going to be, how does a company who's importing goods from China issue letters of credit, bills of lading, pays for import taxes, insures their freight. All that's going to be done on blockchain-based technologies. It's being developed currently by IBM and others for all of the large shipment companies. And you will find a type of virtual currency that will be used for effectuating all these transactions that will be some form of basket of fiat currencies. So let's call it trade coin, and trade coin consists of an index of dollars, euros, renminbi, yen, Swiss francs, Bitcoin, and Ethereum maybe. And it is a type of currency that has a constant value, meaning it's not something people invest in because it's going to go up and down. They invest in it and use it because it stays extremely stable, so that when you're ordering a machine manufactured in another country, and it maybe takes 6 months to have it delivered, you know that the price you're paying isn't going to fluctuate because of currency risk. And today when people buy goods and services internationally, they hedge them by buying a future in a foreign currency, and all that can be eliminated using some of these smart contracts. So smart contracts and blockchain, hugely disruptive. Virtual currencies, not disruptive.
That's an awesome, thoughtful answer, and I appreciate it. And I want to before we went live, I was asking you a little bit about how you got into cryptocurrency or how you got into blockchain. So just explain to everybody sort of your background so they have a context, because I'm like, I want to listen to this guy, and that answer is why I want to listen to you. So tell us how you got into all this.
Sure. So my very first job in the technology industry was at the age of 17, writing software for banks in London. And that was obviously many years ago, actually a little over 40 years ago. And so I've been involved in the fintech industry for many, many, many years. And on top of that, my family background, many bankers, one of whom was actually a senior economist with the OECD, who helped bring a number of countries into the OECD and then into the EU from a regulatory perspective, specifically around securities and banking. And so I've been very familiar with the whole regulatory environment for lots of years, and have been either a founder, a contributor, or a CEO or a board member of companies doing banking type applications, fintech applications, trading applications, for many decades, obviously. And have also spent time on the investment side as a managing partner of a private equity firm. And in the past few years, I've really been quasi-retired, you could say, and focused on really advising large public and private companies, private equity firms, and others on how to create value. And a number of the companies I'm involved with, either as chairman of the board or as a board member, are in spaces that touch crypto. So, for example, I'm chairman of the board of a company called Sequent Software in Silicon Valley. Sequent is a company that develops the tokenization technology that tokenizes credit card payments on your phone. So if a bank issues a debit card or a credit card and you want to use your phone or some other digital form to pay for stuff, you have to tokenize those payments. And Sequent is a core part of that infrastructure in the world. So I understand very well how to tokenize things. And virtual currencies are a token, and they tokenize things, right? On the other side, I'm also been involved with a German company called Utimaco, which is a 30-year-old company that's the leading cryptography company, one of the leading cryptography companies in Europe, most probably the second largest today. And their technology is used to make sure that the software that's being downloaded to your Tesla hasn't been hacked. They're the technology that's used by the power company to read power meters and make sure people don't hack them. They're the software that makes sure that German passports can be issued in a way that the digital passports can't be hacked. So very involved in cryptography, very involved in payment tokenization. And about a little over a year and a half ago, I asked my co-founder, who I'd known for a number of years, who's been in the payment space, why is there so much friction between the world of digital and the world of fiat? And we really did a bunch of work and realized that there are a lot of pain points around regulatory risk, legal risk, jurisdictional risk, meaning venue, the location, and just systems risk that and counterparty risk, meaning the person you're trading with, the person you're exchanging tokens with, and there was a lot of risk around just theft and security. And we felt that a lot of our common experiences and backgrounds could be applied to solving that problem. And what we really wanted to do was create an ecosystem that allowed you to safely and using traditional institutional means, meaning banks, broker dealers, exchanges, etc., trade and use digital assets, such that digital assets could be as common as investing in a mutual fund or buying and selling a car or something online. And so Sprocket's the focus is all about creating this next wave, what we call digital asset trading 2.0. And just one thing that's important to note, if you look at the world of where these sort of digital assets are going to go, things like Bitcoin and Ether and what we call virtual currencies are going to be the vast minority of the things that are tokenized. It's going to be every car, every house, every life, all your personal data, all your healthcare information. It's going to be buildings, any asset that today can be bought, sold, or owned is going to be tokenized. And the future of trading is going to be all about, I'm going to buy a commercial building, I'm going to issue tokens, and people can buy and sell those tokens very freely. And that's how capital formation is going to work. That's how capital distribution is going to work. That's how portfolios will be held. It's going to disintermediate a lot of all these players that have created friction in the marketplace by making assets very illiquid. You know, you buy a building today, you raise a partnership, your partners can't easily sell their partnership shares. But if it was tokenized and it was on an exchange, then people could buy or sell. Hey, I want to own a token in the Empire State Building. I want to own a token in Coca-Cola. Think of Warren Buffett. You know, he likes to invest in companies who make products that he likes to use and own. Well, with tokenization of assets and by doing that digitally, anybody could own a piece of anything if they wanted to.
And where do you see, and I'm just curious, this is sort of for people out there that are watching this, what would be the difference when you say tokenized? What's the difference between like tokenized and buying a share of a real estate investment trust, for example?
So a share in a real estate investment trust is a form of token. It's just a piece of paper, or it could be electronic, that simply states that you have the right to whatever that piece of paper represents, which is a certain percentage of the value of the asset that it's a share of, and whatever dividends and other things. So a share certificate is a manual smart contract, if you think of it that way. It's a physical piece of paper that has a legal contract associated with it that bears with it certain rights and privileges and responsibilities. The problem today is that there are lots of legal issues with, you have to form a company, you have to issue shares. There's a whole body of law around how shareholders have to be treated. And there's a whole bunch of regulation about how you can sell shares, how you can market your investment, et cetera. None of which really exists today for digital tokens and digital assets. And a lot of that is the underlying foundational work that still has to be done to bring digital assets into the traditional world, if you would, because the traditional world isn't going to be brought into the digital asset world. It's going to be the other way around. Too much groundwork has been laid in the traditional financial markets and legal frameworks for it to work the other way around.
Awesome. And so when you talk about the friction in the marketplace, you see this opportunity to take advantage of that friction. What do you see as some of the challenges with digital asset trading today?
Sure. So think about it this way. You have regulatory risk, right? Here's a simple one. If in the U.S. today, you have a number of different people who opine on, and I'm talking about government or institutional, who opine on things like Bitcoin. So is Bitcoin a security? Is it a store of value? Is it a commodity? Who regulates it? The Commodities Board or the SEC? The IRS thinks it's a commodity. It's something you pay capital gains on, for example. If you want to set up a digital exchange in the U.S., you have to first, typically, you're going to need to get registered as a broker-dealer and regulated by FINRA. Then you're going to have to apply for an ATS license. Then you're going to have to get permission from a lot of different states in the U.S., which is a very expensive process. And then you're going to be regulated by the SEC. So SEC, FINRA, each of the states, it's a multi-year process, very expensive. And today, there are a number of exchanges out there that don't have all the regulatory licenses. And so if you're trading on those exchanges, and I think Wall Street Journal published something yesterday where the SEC basically said they want to investigate every single Bitcoin trade that has been done on an exchange in the U.S. because they believe manipulation has happened. The government regulators are there to protect the consumer, if you would. And as soon as they think bad actors are involved in marketplaces, they regulate them heavily. And what's the best way to regulate digital trading? It's basically apply the same rules as there are for stock trading. So ICOs will be regulated just like stock offerings are regulated, because ICOs are security offerings of security at the end of the day. Moving money in and out of crypto will be handled the same way moving money in and out of bank accounts will be. You'll have to go through a know your customer KYC process. You'll have to go through anti-money laundering processes. All of that's going to be the exact same. So there's a lot of friction, because today you can't do that. You can't go to a bank and say you want to buy, you can buy euros, but you can't buy Bitcoin at a bank, for example. Yeah. And so until that happens, there's going to be friction. And so we really need to build that ecosystem of institutions that are licensed and regulated to do this. So with Sprocket, we looked at the US and we said, big market, but it's going to be one of the last markets to be properly regulated. And why is it important for a market to be properly regulated? Well, if it's not properly regulated, there's risk. And so if I'm going to trade with you and it's only a matter of a couple $1,000 or maybe $10,000, I'm willing to take the risk that you're not going to rip me off and the government's not going to step in and block the trade and confiscate the Bitcoins, because maybe I bought Bitcoin from somebody who bought Bitcoin from somebody who bought Bitcoin from somebody who stole that Bitcoin from somebody. And, you can see the provenance of any particular Bitcoin. And even though the decentralized ledger in theory is an immutable ledger, if I steal your private keys to your wallet and I get access to your Bitcoins and I sell them to somebody, there's nothing on the blockchain that says that that was an illegal transaction. It just looks like whoever had the key took the Bitcoin, sold it. It's fine. But it's kind of like, imagine, and you mentioned earlier, you're just closing on a house. So imagine you go buy a house and you don't have title insurance on the house. And you move in and you're happy. And 2 years later, you've invested in a major remodel in your house and somebody knocks on your door and says, "Get out of my house." And you say, "What do you mean?" And they say, "Well, here's this title. I owned this house 10 years ago. Well, I bought this house 10 years ago. Well, I'm sorry, I own it now." And, they might be able to actually prove that somebody stole the title and sold the house to you without their permission. That has actually happened. It still happens to this day in places. And so, there's a lot of risk around trading. And so institutions won't get involved in trading Bitcoin because they want to today with the current systems, because they want to buy in the tens of millions of dollars and trade on a regular basis. And if there is counterparty risk, meaning a risk that the person they're dealing with is going to rip them off or isn't a good actor, if you would, and if the institutions they're trading through, the exchanges, the wallets, etc., might have their balances confiscated or shut down by the government, then they won't want to trade in that environment. So we're really all about building licensed and regulated exchanges, licensed and regulated broker-dealers, and licensed and regulated trading platforms that allow people to trade digital assets anywhere in the world in full compliance with government rules, with a minimum of friction out of a single account and a single wallet.
That's awesome. And one of the things, you said something interesting there, which I think plays in here. You said that the United States is a big market and that it will be the last to be sufficiently regulated. Why is that?
So if you go to Europe today, and you go to Switzerland, Zug, Crypto Valley, and you want to establish an exchange, there's only one regulator you have to talk to. It's FINMA. And whether you want to be a bank, whether you want to be a broker dealer, whether you want to build an exchange, it's FINMA. Period. No questions asked. And Switzerland is a country with 13 cantons, which act as very independent states, but FINMA is the regulator. In the U.S., if it's banking related, you've got to deal with FinCEN. If it's securities related, you got to deal with the SEC. If it's a commodities issue, you got to deal with the commodities regulators. Then you have to deal with the state of New York and the other 49 states, all of whom have to license you properly. And so there are so many people that you need to get licensed by that there's a lot of friction. And that system has remained as complex as it is, as a way of making it very hard for new people to enter the market. And I'm not spouting some conspiracy theory. It's just simple fact. No national exchange has been established in the U.S. In most probably nearly 100 years, since the 20s. And it's going to be very hard for anybody to achieve the ability to do that. And there are people like T0 who have spent millions and millions. I mean, in the tens of millions annually in legal fees just to try and get the regulators to approve what they're doing. And look no further than Coinbase, who's having to buy a broker-dealer, buy traditionally licensed institutions as a way to sort of come out of the dark and into the light, if you would, the way the regulators view it.
That makes sense.
Keep going. As you look at this world, I'm just saying, as you look at this world, then now let's talk about, I want to move fiat into crypto. So, today you want to go buy an ETF, you go to, whoever your stockbroker is, whether it's Charles Schwab or you do it through E-Trade or whatever, and you just deposit money in the account and you go buy what you got to do and you can sell it and trade it. It's pretty easy. Try doing that with crypto. In some cases you have to go to Kraken, for example, buy your crypto in Kraken, and then you've got to transfer the crypto to the wallet on the exchange where you want to trade. And then, you've got this thing called slippage, which I'll get into in a minute. But you've got these issues where, the on-ramps and off-ramps to go into crypto from cash and cash into crypto are very difficult because the governments don't want people to be able to easily move in and out of crypto because 30+%, as the regulators argue, I'm not saying this is true or not, it's just a statistic the regulators issue, is money that is being laundered, or it's, ill-gotten gains, whatever, however you want to define it. It's money that in the traditional banking system couldn't be used for transacting business. And so the government regulators have effectively said, we're going to make sure that it's really difficult to keep for money to go in and out of crypto to fiat so that we can control the money laundering until we have systems in place that let us really identify the full provenance, the full life of a particular Bitcoin, if you would, so that we can know without a shadow of a doubt who has owned it, not the anonymized who has owned it, but the real who owned it from when it was mined until it ended up in whatever account it's in right now. And, so to get all of that put in place, when you have multiple actors involved, like you do in the U.S., multiple stakeholders, it's difficult. Again, the commodities regulators and the SEC are still arguing as to, is Ether a security or is it a commodity?
Yeah.
And until they decide that, it's going to be confusing. And, when there's confusion, there's risk. And when there's risk, it causes a discount to value. Because people say, well, if I'm going to trade with this, you might say it's worth, $1,000 a token. I'm going to say it's only worth 500 because there's risk that it might be worth nothing tomorrow because the government might make it illegal. And, you've got the whole issue today with security tokens or tokens that are being deemed to be security tokens quasi after the fact. So you look at, again, the Ether, and Ethereum, if the regulators decide that was a securities token, the big issue isn't the fact that, it's now a security token, so there are different rules for holding and trading it possibly. No, it's the fact that how it was sold would then have been in violation of securities laws. And there's some people that are going to be in big trouble because of it. Look at what's happening in the whole promotion advisory industry for crypto today. It's the regulators are coming and saying, hey, these are security offerings. And if you weren't a licensed broker dealer and, et cetera, and you've been out there promoting something on a contingency basis, you are in violation of the law.
Yeah. Yes, most definitely. Now, here's a question. So that's a great point that I never thought about, is that there are more regulatory bodies in the United States that are maybe more disconnected than other countries. So what is Sprocket's vision? How in the world, from a macro level, I'm certainly not going to ask you about regulation on a micro level, but how are you guys going to be able to navigate that? I looked at your timeline and it looks like you're doing it the right way with each one of these, the EU and the United States. What's your vision for navigating that?
Sure. So we spent about a year and a half talking to regulators all over the world. Spent a lot of time talking to the Swiss regulators, the variety of other European nation regulators, and in Asia. And so we've determined that for us, Liechtenstein is the best venue for our first exchange. Why? Because they're in the process of finalizing the formation of their regulatory environment. The way they're forming the regulation gives us clear sight to being able to have a licensed and regulated securities exchange, meaning an exchange that can trade digital assets that are considered securities. And so we will be able to list and trade any token that's a security token that passes the underwriting requirements that we have. We'll also be able to be a market maker through our broker dealer. We'll also be able to have fund instruments. And because Liechtenstein is part of the EEA, which is the European Economic Area, we'll have passporting across all of Europe. As we then move beyond sort of Liechtenstein, there are other venues like the UK, Malta, and then into Asia, Singapore, Japan, and potentially Hong Kong. So our vision is very much focused on, we work with the regulators to get properly licensed. And once we have our licenses, we open for business in that marketplace. And, we believe that over the next 2 to 3 years, the regulators in most of the world are going to be pressured to clamp down on unregulated activities by people in the space. And when that happens, it's either going to be the incumbents like the NASDAQ and the large Goldman Sachs, the large institutions of the world, or it's going to be the newcomers who have taken the time, energy, and expense to go and get properly licensed and regulated.
Yeah, I was going to ask you about that with, that's interesting. Let's touch on that for a second. When you're looking at the big institutional players, so you guys are going to be ahead a little bit with regards to navigating some of these things. You mentioned the market's just not big enough yet. Is that one of the reasons, Fred, that they're just not diving in right now? Or is it for the same reason you mentioned with the regulation?
Well, I mean, so look at last year as an example. Up until June, there wasn't this huge frenzy around crypto. And, go back to any asset bubble, whether it's the tulip bubble that people talk about from, a couple centuries back, or whether people are talking about the real estate bubble that occurred in the early 2000s. When the nanny who takes care of your kids starts talking to you about, flipping homes and owning 5 or 6 apartments, and they're excited about that, you wonder what's their kind of, do they really understand what they're getting into? Well, the second half of last year, that was what was happening in crypto. Everybody was saying, oh my God, you can't but make money. You have to get involved. The market was overheated. Everybody was getting into the marketplace. And at that point, the regulator said, somebody is going to get hurt. This isn't a bunch of, no offense to our listeners, this isn't a bunch of nerds out there playing around with this countercultural thing called decentralized economics and cryptocurrencies. These are, people who are leveraging on credit cards. They're running up $100,000 in credit card debt effectively to go buy Bitcoin, thinking it's going to go to 40 and 50,000, and people are going to get hurt. And when they do, there isn't a regulatory body, there isn't a framework to provide them with any protection or insurance. There isn't FDIC. Like if your bank goes out of business, the FDIC insures your deposits up to a limited amount. So if you don't have those protections in place, people are going to get hurt. That puts a lot of pressure on the regulators to go put regulation in place. And the one thing the regulators don't like to do is to put in place regulations that are knee-jerk reactions. Dodd-Frank, which is in the process of being unwound today, was a knee-jerk reaction to consumer lending issues. Well, the regulators don't want to go through that whole debacle again, especially considering the political parties that are in power right now in Washington. So when the pressure came off cryptocurrencies in the beginning of this year, they felt, okay, there's a little bit less pressure on us to move quickly, so we can now take our time and kind of do this the right way. And the best thing that can happen for the regulatory environment in the U.S. is that the market kind of just ticks along the way it is right now. No big scandals, and they can formulate regulation and create an environment that's going to be beneficial for everybody. That being said, it's even trading stocks is still a bit of a wild west. So I think the regulation will make it safer, but there's lots of opportunity in the meanwhile for people who are willing to build regulator-friendly businesses.
Yeah, that's great. So you did talk about blockchain and how you're going to see lots of different assets being tokenized. Can you just do you think these things are going to be exchange type of things, or how will we see that play out in your opinion, Fred? So if I want to tokenize my house instead of getting a mortgage, like, a reverse mortgage gives me money to retire on, but maybe I want to tokenize my house. Is that going to happen, or do you see it as bigger assets?
No, I mean, it's going to start with bigger assets. So like a REIT. A REIT is really a perfect example, right? It's a real estate investment trust. I buy a share of it, and it's like a fund that goes and gives me pieces of actual buildings. So that will be tokenized. So stocks and bonds, those types of instruments will become tokenized first. And then what's going to end up happening is there'll be vehicles like the OTC market, for example, or what are called pink sheets today, that will allow you to be able to effectively trade assets that are of smaller value. So homes, boats, cars. So think of it as, basically eBay, where you can buy individual pieces of something. Not unlike the way the crowdfunding market works today. I think you're going to see a very interesting sort of conglomeration, if you would, or convergence of the types of assets that today are done through non-traditional means moving into this traditional market.
Yeah, with no offense, we've had some just phenomenal speakers the last 5 days, and with no offense to any of those folks, that's the most fascinating thing anybody has said that I have watched, is how the future will be tokenized. I think that's really cool. Let's talk about smart contracts. What needs to happen here in order to make them viable and reliable for large volumes of business?
Sure. So, a smart contract is effectively the way you would tokenize a house. It's one and the same thing. A smart contract is I'm going to put assets in escrow, and those assets are held in escrow until some terms and conditions are met. So a letter of credit in traditional trading, world, is really just a smart contract, only it's a manual process, and there's the central authority who's responsible for controlling that. And sorry, I'm having the cat removal.
Yeah, no
going
worries.
on here behind me. And it's a smart contract is literally that. It's an intelligent legal instrument in theory that means that when you give me the title to your home, the Bitcoin that's in the smart contract will be released to you. And it's an overly simplified example, but the problem today is that smart contracts aren't written by lawyers. Smart contracts are written by people who are used to writing software, which means it's Boolean in nature, which you would think would be, immutable, but unfortunately, it's not. And there was a recent study that's been done. One of our advisors is a researcher who been focusing some time lately on smart contracts. And, of 95 plus thousand smart contracts that were audited using a variety of tools, 36,000 of them were found to have major flaws in them, which meant that they could either be, people could take advantage of them, people could effectively hack them, and in some cases they would go into run conditions, which is a programming term, where they wouldn't operate properly. And so, that creates counterparty risk, which is, one of the many friction points we define in our kind of presentations as we talk about this world, is you have counterparty risk. And so, do I really want to set up a smart contract to buy your home or your car or your Bitcoin, for that matter, based on, some conditions being complied with, if there's a high degree of risk that it won't actually work? And so there's a whole need for the smart contract ecosystem and tech stack to have in it tools that make it trustable. So, for example, credit cards, when they were first introduced, people were skeptical as to whether it would work properly. How did the merchant know they were going to get the money from the bank who had issued the card? Or in that case, in this case, it was for Visa and MasterCard. Because before, you went to Macy's, you opened a Macy's charge account. It was a Macy's card that you used. It was Macy's charging, getting money from Macy's credit, and Macy's credit then went after you for the money, and you had to pay your bill. Well, when it's a bunch of third parties that get involved, it's a totally different story, and there needs to be trust. And today, I certainly wouldn't want to transact commercial business using smart contracts today without having those smart contracts fully audited by a PwC or one of the major auditors that today have been building out teams that are specializing in auditing smart contracts. And these smart contracts are going to get very complicated. As an example, I believe IBM is doing a project for Maersk Line, which is a Danish shipping company. It's one of the largest shipping companies in the world. Think cargo ships. And it's all about putting the whole world of international shipments on the blockchain. And I'm not talking about Bitcoin blockchain. I'm talking about Hyperledger in this case is what they're using. But they're effectively putting, so every container that gets booked and put on a ship and sent somewhere is tracked through this whole process. The contents of the container are tracked through this process. The customs payment, the shipment payments, everything is done through smart contracts, such that it's a fully automated process with no need for intermediaries. And very complex thing. And is it being done decentralized? Absolutely not. It's being done on Hyperledger with a central authority who controls all of the data, and that is Maersk. But that is a way that this technology is going to become everyday and prevalent. It's when you have a trusted authority who controls it. And when it's you and me writing our own smart contract, like we download from a legal website online, a bill of sale, we fill it out, and then we do a deal. A lot of those still end up in court because people didn't fulfill the conditions. Well, you and me writing smart contracts to each other, we're a long way from that being viable from a legal perspective and risk perspective. You can do it today, but if you were to take it to court, the courts wouldn't know how to deal with it. So you need all the ecosystems, and the infrastructure needs to be in place for these types of technologies to have an effect. And even though the cell phone, and look at smartphones in 10 years, what they've done to the world, blockchain will be that type of technology. Digital currencies and smart contracts are going to take a little while to get there. So
with that being said, you talked about market consolidation. So as all this stuff plays out, you talked about the crypto market, so to speak, kind of getting sucked up by the regular market. Can you talk about that? Like, what do you see happening with all these major players
Sure.
that are right now making up this $350 billion market?
Right. So let's use the U.S. as an example because there's been a lot of these types of transactions in the U.S. So Poloniex, as an exchange, was acquired by Circle, whose major shareholders are a bunch of very large banks. So traditional institutions, if you would. Why was Poloniex acquired? Well, Poloniex was likely, and I'm not going to say this is a irrefutable fact, but I can take it on the fact that I believe the people who have said this to me were correct. Poloniex was in violation of a bunch of regulations regarding trading that was going on in the exchange. And they either were going to get shut down, or a good actor, somebody that the regulators like, such as an existing large institution, would have to acquire them and kind of reboot them. And if you look at what Coinbase is doing today, they're having to go buy a broker dealer. They're having to go get ATS approval. Why? Well, because what they're doing today, technically speaking, will be in violation of the rules as the rules get established. So they're having to go and acquire traditional institutions to become a traditional institution. The NASDAQ is going to start trading, digital instruments here, most likely this fall. And based on what I understand from regulators, the G20 is likely going to drive regulation in its member countries, the G20 countries, to effectively allow banks to hold a handful of what are called virtual currencies, the acceptable ones, Bitcoin being one, of the 3 or 4 that they'll likely approve. And at that point, again, the institutions, the banks will be the people that are the on and off ramp for these things. And so we believe that in the next 3 to 4 years, there's going to be a ton of consolidation amongst the exchanges because there won't be a need for 200 exchanges. And let me just touch on slippage for a second. Today, outside of the top 5 exchanges in the world, and by the way, the top 5 exchanges in the world do less than 20% of the trading volume. If you were to do a $50,000 trade for Bitcoin on exchange number 10 in the world, you will move the price of Bitcoin on that exchange by possibly 5 to 10%. So that's slippage. When a trader goes in to do a deal and they move a market, that causes slippage. And so, the issue is there's not a lot of liquidity in these smaller exchanges, but people like to trade there because of arbitrage. And to be able to effectively do arbitrage, you have to hold balances on all these various exchanges. And so how do you do that? It's not that easy. So I think my video feed just went down, by the way. But
yeah, it's I can still hear you, and you got me hanging on your words here.
So the video is rebooting. So apologize for that. Not sure what happened there, but
no worries. So here's a question then: as these markets, these exchanges get consolidated, then do you see? We talked about kind of tokenizing the world a little bit. How do you see the future of ICOs as tokens and fundraising mechanisms?
So I think the days of ICOs are as they've been, sort of at least through last year, are gone. What you're going to have are ICOs or token generating events, if you would, are either going to become crowdsourcing, fall into the regulatory environment of crowdsourcing. So 506 C and B, Reg A plus, fully regulated offerings. Either high net worth individuals, Reg D, Reg S, or Reg A plus, where it's a public offering but for smaller size, or it's just going to be a true utility that's sold within an ecosystem or marketplace for use only on that ecosystem or marketplace. But that can only happen once the marketplace exists. So anytime anybody is raising money through selling tokens to build a product, it is a security, as viewed by regulators in most countries in the world today. And as securities, they can only be bought and sold technically through, broker dealers, unless, it's a high net worth accredited investor who's filled out all the proper paperwork. So the ICO marketplace, as I view it, is really you're going to have to form fit yourself into the traditional regulatory frameworks. So you're either going to have a broker dealer promote your deal as a Reg D, Reg S, or you do it directly yourself to people or you go through a Reg A plus process. There are companies out there like Start Engine in Santa Monica that has become very active in what they call ICO 2.0, which is really just a crowdsourcing, only different, as a way to help people raise money. But you can't go out there and promote online with Telegram groups and Reddit groups and ads on Google and Facebook. Today it's getting harder and harder to promote events even that deal with crypto, because there's such a stigma around the fear of the regulators saying, "Oh, you participated in marketing an unregulated offering, and therefore you're liable." And that's part of the downside of the regulatory environment, is that if you are promoting a securities offering that's been done not in accordance with the rules, then all the parties involved in the promotion are liable. So whether you're an advisor, whether you're an influencer, whether you're an actual promoter, it's not the company that's liable. It's everybody that was involved in the promotion of that deal. So I think the market is going to change dramatically here over the next year or two as regulations really start coming into place, and it's going to look like the traditional market. And I even see it today. People who we talk to about our tokens and our model, they're saying, buying tokens is great, but what about equity? So, the days of just being able to sell tokens, raise a lot of money, and deposit that money in some nice bank account somewhere, and have the luxury of building your system without having given up equity, I think are numbered.
Okay. I think that's a really good point, and you kind of seeing that play out. Now, I have one more question for you, Fred. But is there anything that we didn't get to today that you wanted to cover? We've got about 10 minutes.
I think it's for when you talk to people who are interested in outside of just speculating in Bitcoin or Ether and where the price of these things are going to go, and that's a whole topic unto itself, obviously. People who are interested in investing in the companies that are in the space, I really think have a good hard look at the management team and see, have they ever built anything like this before? What have they done leading up to their offering that tells you that they understand exactly the regulatory framework that their business is going to fit under? And, does their business plan include becoming a fully licensed and regulated entity in that space? It's just like if you were going to start an airline today, if you're going to invest in an airline, you would want to make sure that whoever is behind that deal understands the airline business really well. And, oh, by the way, understands all the rules and regulations involved in it, et cetera, and is going to do something about it. So the days of just being able to invest in every ICO and walking away at the end of the year with a nice profit, even though 80% of them might have failed, are gone. And so, buyer beware, really focus on quality offerings. And the quality offerings aren't necessarily the ones that raise $4 billion and don't know what to do with them. Quality offerings are the ones where there's a real underlying business that's going to be there, 4, 5, 6 years from now, that has a real vision and mission. And I think, those are the types of deals people should be focused on.
Awesome. I think that's good advice. Here's my last question for you, Fred. Before we went live here, you said you wrote your first software program 40 years ago for a bank. And my question to you is, on a macro technology level, you've been through it. You saw the internet come about. Now you're seeing blockchain. How excited are you for this technology?
That's a great question. So, I have over the years developed a philosophy and a framework for how I look at any industry, any marketplace, any company, anything. And I call it the 6 A's, like the letter A. And I look at anything and I identify, in any process today, you can identify friction, whether it's ordering an Uber. There's still friction in ordering an Uber. You have to wait for the person to accept, and do they show up, and are they safe? There's still friction in that process. So any process, I believe, can be automated. All the manual steps can be automated. I believe you can accelerate them. I believe that systems can become intelligent and anticipate what the customer wants, and that makes them even better and even smarter. And I believe that they can become adaptive, so they change based on how users are using them. And if a system can do that, if you can do that with a system, then you'll create an amazing user experience, and happy customers or amazed customers will activate, which means they'll use the product or service more. So, as I've looked at technology over the years, it's always been, what are the types of things that are going to be able to allow us to automate, accelerate, anticipate, and adapt, such that we have amazed users that then use whatever it is. And the smartphone was one, e-commerce 1.0 was that, the internet per se is that, blockchain is definitely that, IoT is another one. I think predictive analytics and AI is a huge piece of this as we go forward. And it's going to be such an integral part of our lives that it'll be so transparent that we won't even notice it's there. And, matter of fact, I tweeted a thing today that voice recognition technology has now gotten to the point where it's the equivalent of what's called human accuracy, which means when somebody talks to you, if you understand 96% of what they say, then you're about as good as a human is. And today, the voice recognition systems of the world, the Alexas, if you would, are just pushing past 96% on the way to 100%. And as soon as they get good contextual understanding, so contextual understanding, for example, you asked me this question based on a conversation we had, an hour ago, kind of. So that you and I both have context for the question because we had talked about it. Well, AIs are now getting to the point where they have short-term memory and long-term memory and can remember parts of conversations so that you don't have to ask a question with all of the important parts to it, even though you've already talked about them. And so I think AI is going to be a huge part of how we trade and how we do business. As we look at crypto, AI trading is going to be a huge part of this because humans won't be able to trade at the speed that machines will. And you talk to anybody who's doing arbitrage in the crypto world today, and the issue is more about getting money on the right exchange so you have funds in the right place to take advantage of a price inefficiency than it is about figuring out what the trade should be. And as soon as there's no friction in being able to execute a trade, you can then throw a lot of computing power at figuring out, quant type algo driven trade strategies. And there are a lot of people waiting on the sidelines for that to happen who've been doing that in the stock market, who just want to do it in crypto. So it'll be exciting.
Awesome. Well, Fred, I appreciate it. Thank you for taking the time to come and talk to us today. I just thought this was fascinating and interesting. So thank you.
You're very welcome. Appreciate it. Sorry about the video quality, but that's what happens when you live in paradise. So
yeah, it's great. So thanks to Fred, and I'd like to remind everyone that you can own this entire training summit through our cryptocurrency training kit. It's going to get you downloadable access to the videos, audios, transcripts, and bonus gifts of the 35 plus speakers, all for $297, including Fred's speech here. You're also going to get a special bonus called the Crypto Mastery Program that we are producing right now, Roger Bryan and myself. And after the summit, the price of this training program is going to go to $497. So if you'd like to own the materials and refer back to them at your convenience, now is the time. Again, everybody, thanks for joining in. This is going to be, the replay is going to be up here probably within the hour. I would advise you to listen to it again. I think that there are a lot of people out there, both on the libertarian side and on the capitalist side, that really need to listen to Fred and understand how these markets are going to converge. So it may not fit your idealistic views of what this is going to be, but I think that Fred is in this space. And when I say in this space, I mean, he is deep in these markets and in the tech markets, and obviously an intelligent and thoughtful person. So I think you need to listen to it again. And so again, thanks, Fred, and we'll see you guys in the next talk coming up. See you guys.
Thank you very much. Appreciate it.